Okay, welcome back. Today we are diving straight into the money trail, following the big institutional players, seeing where they're placing their bets. If you follow the markets, those quarterly 13F filings, they can be like a treasure map sometimes. And our mission today, well, we're digging into the latest filing from Jackson Square Partners, JSP, big fund. Their November 5th disclosure showed this brand new, pretty significant stake in a payments company, Shift4 Payments, tickers F4UR. So we really need to unpack what GSP might be seeing here, especially given, well, the stock's recent ride.
Exactly. And just quickly for anyone maybe less familiar, these 13Fs, they're mandatory, right? For funds managing over $100 million in what we call assets under management, AUM. It's not just paperwork. It's a required peek behind the curtain. Shows you what these experienced managers are holding. And when a fund like JSP opens a new position, that usually signals, some pretty serious research went into it. They're deploying capital based on a thesis.
Right. So let's get specific on the trade itself. The filing showed that as of September 30th, 2025, end of Q3 JSP, bought 74,100 shares of Shift4. That stake was worth, what, about $5.74 million at the time? Seems straightforward, but what does that mean for a fund their size?
Well, context is key here, definitely. That position, $5.74 million, it works out to 2.32% of their reported 13F assets. Now, okay, maybe $5.7 million doesn't sound huge for a giant fund, but dedicating over 2% to something brand new, our sources specifically call that meaningful. It signals real conviction. They're not just, dipping a toe in the water here. This isn't a tiny starter position.
Okay, but let me just push on that meaningful bit for a second. I mean, we look at their top holdings, right? NVIDIA, Microsoft, those are way bigger, like 7.77% for NVIDIA, 7.3% for Microsoft. Those are massive core positions. So is 2.32% really strong conviction, or is it more like their strongest new idea maybe in a small cap space?
That's a totally fair point. And it kind of gets into how they build their portfolio. Those 7-8% slugs, yeah, those are usually their established, maybe more mature core holdings. But for a new name, especially in a space as competitive as payments, getting over that 2% threshold right out of the gate, that's significant. It suggests they see a path forward pretty clearly, whether it's like a short-term catalyst or a longer-term growth story. It's a real commitment. It moves the needle for them.
Got it. Okay, that framing helps. They see something immediate. So let's pivot then. The company itself, Shift4 Payments, FOUR. If you're putting 2.3% of your reported money into it, you need to know what it does. So what's the business?
Yeah, Shift4, they're not just like the little square reader you see sometimes. They're way more comprehensive. Think integrated payment processing, point-of-sale systems, their own secure gateways, even business intelligence software. It's the whole package. And they're really focused on this thing called omnichannel card acceptance. Yeah, and that omnichannel piece is super important because think about it. A restaurant or a store, they take payments everywhere now, right? Online, in-app, at the table, at the counter. Omnichannel just means Shift4 makes all those different ways work together smoothly. Good for the customer, obviously, but also great for the merchant, getting all that data in one place. And what's really interesting, I think, is their focus. They aren't trying to be everything to everyone. They target specific industries, these high-volume verticals. We're talking hospitality, retail, e-commerce, but also, notably, big stadiums, entertainment venues, mostly in the U.S., which leads to this idea of vertical integration. They often get really deep into the operations of these big clients, customizing things. Think about wiring up a whole sports stadium's payment system. Once they're in like that, it's much harder for a competitor just to come in and replace them. That's part of the stickiness, part of the potential moat.
All right, so it's not just providing a commodity service. It's about embedding their tech deep inside these specific, often complex ecosystems. Okay, just to ground this for you listening, let's throw out some quick numbers as of, say, early November 2025. Shift4 stock price was around $66.74. Market cap sitting at about $6.09 billion. And financially, but they've got real scale. Revenue over the last year, $3.61 billion. And they're profitable at about $220.5 million in net income. So established, making money, growing. But, and this is a really interesting part, right? The timing of JSP's buy. They did this in Q3 2025. And that was after a really rough patch for the stock. Over the year leading up to that filing, Shift4 was down 26%, which sounds bad on its own. But compared to the S&P 500, they underperformed the market by a huge 45 percentage points, trading almost 50% off its all-time high. Ouch.
Yeah, exactly. So the big question becomes, why jump in then? A lot of people see a stock down that much and think, falling knife, right?
Right.
Too risky. But for a fund like JSP, this might look like, well, a classic value situation wrapped up in a growth company. It's the quintessential buy-the-dip opportunity. They seem to be looking past that recent negative stock price action and focusing on the fundamentals, which they believe got disconnected from the price.
Hmm. I mean, I get the theory, but I'm still a bit skeptical. A stock doesn't usually drop 26% in a decent market for no reason. What are the risks here? What's JSP deciding is, well, maybe not that big a deal.
Well, they're likely looking past the short-term sentiment because the core valuation metrics started looking incredibly cheap, especially for a payments company. Despite the stock getting hammered, the business was still growing. Sales were up 17% in the last reported quarter. Growth is still there, and yet the stock was trading near its lowest valuation range ever. That's the disconnect they likely saw. Let's look at the specifics. It was trading at just 16 times free cash flow. FCF, right? And if you look forward, based on estimates, only about 12 times forward earnings. Paying 16 times free cash flow for a company growing sales at 17%? Well, that's the kind of setup that gets institutional investors very interested. They're betting the market overreacted.
Okay, 16 times FCF with 17% growth. That does sound attractive on paper. So if the valuation looks good, the growth is still there.
Yeah.
The risk must be the competition, right? Payments is notoriously cutthroat, tiny margins, everyone fighting for the same transactions. What's the competitive pressure that's been pushing this stock down?
You absolutely nailed it. That's the main overhang. Intense competition, it's a constant battle. Shift4 faces giants, but also very focused players. Like in the restaurant space, they go head-to-head with Toast, ticker TOST, and Toast has been a real force there.
Toast. And that comparison, I think, really highlights JSP's thinking here, doesn't it?
Yeah.
We just said Shift4 is at, what, 16 times FCF? Toast, yeah, it's growing a bit faster, maybe, but it trades at something like 46 times FCF. That's almost 3 times Shift4's valuation for a company basically in the same sandbox, or at least a nearby one.
Exactly. That huge valuation gap is likely the core of the opportunity JST sees. The market's giving Toast this massive premium, maybe for dominating restaurants. But Shift4's appeal, the bet here, is probably on its diversification and that vertical integration we talked about, which the market seems to be undervaluing right now. Remember the stadiums, the big hospitality clients. Shift4's revenue is spread more broadly across these sticky, high-volume areas. Toast is much more concentrated in restaurants, maybe more vulnerable if that specific sector hiccups. So JSP is likely betting that Shift4's diversification makes it more resilient and that its current 16x FCF multiple is just too low compared to peers like Toast at 46x. They're betting on that gap closing.
Okay, so let's boil this down. What's the key takeaway for you tracking these moves? It looks like Jackson Square Partners is playing a pretty calculated buy-the-dip game here. They're making a meaningful bet. They seem to believe Shift4's focus on specific niches, hospitality, stadiums, that deep integration plus its now much lower valuation outweighs the very real competitive jungle it lives in. Buying growth, but hopefully on the cheap.
Yeah, I think that's right. And it really underscores a common theme you see with institutional investors, right? They hunt for quality, they hunt for growth, but they love finding it when the price is temporarily beaten down. They have conviction that Shift4's tech and its specialized client base, that stickiness, will eventually earn it a better valuation multiple as the market maybe recognizes that resilience.
Right, which leads us to one final thought, something for you to maybe chew on as you watch this space. We talked about Shift4's tech and how it integrates deeply into places like stadiums, their moat, so to speak. But how strong is that moat, really? These lucrative verticals, big stadiums, major hotel chains, they're also targets for the absolute biggest tech players out there, right? How well does Shift4's specialization actually defend them if, say, one of the true giants decides they really want to dominate payments in that specific vertical long term? Something to think about as this investment unfolds.